As people are signing in, and before we begin, I want to let everyone in the audience know that we do plan on recording today's seminar. Please feel free to put any questions that you have in the chat and we will address them at the end when we have time set aside for Q&A. Also, if you want to go back and listen to this seminar or share this information with anyone in the future, you're able to find the seminar and others on our YouTube channel. Hello, everyone, and thank you for joining us today for part 4 of MMFCU's Financial Health Series, How to Build Your Credit webinar. My name is Jackie Lopez. I'm the Marketing Director here at the Credit Union. Joining us today, we have Andrea Gedeon. Andrea is the Financial Literacy Coordinator at Springfield Technical Community College. Her goal today is to educate on what a credit score is, how the score is factored, why it matters, and the different strategies you can take to improve it. Thank you, Andrea.
All right. Thank you, Jackie. As she said, my name is Andrea Gedeon. I'm actually the Financial Literacy Coordinator here at Springfield Technical Community College. And yes, so one thing I am very passionate about is financial literacy and bringing awareness to anyone and everyone that is willing to listen, but even more to our younger demographic. But I won't bore you with any more of my spiel. Let's get straight into it. So the first thing we're going to do today is talk about how to build your credit. And hopefully from this, you'll be able to implement one thing that you'll be able to start doing on your financial journey. All right. So first up is credit. And it's pretty simple. Credit is the ability of a customer to obtain goods or service before payment based on the trust that the payment will be made in the future. Now, I don't know about you guys, but I'm not the most giving person when it comes to handing out money. However, I was brought up on one phase that kind of guides me when it comes to giving and lending money from my parents. And they say, don't lend money that you expect to get back. Meaning, if you're going to lend money out to someone, be okay with the fact that you may never see that money again. And I can't tell you how much this has guided my giving or lending of money experience. I don't know about you, but I feel like most people, if not everyone, at some point in their lives have been burned by someone who said they were going to pay them back. And they not only never saw that money again, but sometimes never saw that person again. Now, talking about trust, right? Going on to the next slide. This trust, if you will, can go one of two ways. You can go to the next slide after that. There we go. The first being a more safer route with the extension of secured credit and the other being unsecured credit. With being in this industry, I'm sure most of you have heard of these terms, but bear with me so I can explain and break it down for those who may not have heard of them. Definition time. So secured credit, according to Equifax, is a special type of credit that allows for you to borrow money with a cash deposit, usually equal to your credit limit, to be made available to you at the open of the account. That money that you deposit gets put away and held and acts as collateral every time you make a purchase on that secured card, making you less risky of an investment. In the event that you don't pay it back, they have that deposit or collateral, if you will, as a means of paying themselves back so they don't incur any risk, right? The other is unsecured credit. This one does not require a cash deposit. You still have a credit limit, but you're considered more of a risk to the company if you default or don't pay back your loan on time. Now, while these two do sound like polar opposites, they have a few things in common. They both offer a set amount of money to borrow, aka a credit limit. You have the ability to earn cash back, points, and other rewards with both types of credit or cards, if you will. And both of them usually charge some sort of interest or fees on the balance that's owed. They both require a minimum payment each month, and they both impact your credit score. The differences, though, between them, unsecured loans are harder to obtain, i.e. that risk factor. Unsecured credit cards do not require a cash deposit. And if you are proven as trustworthy through your credit score, which we'll talk about more later, you can potentially get a higher credit limit with an unsecured credit card. If you're building your credit, you may want to start with a secured credit card to improve that credit score, which will then make you look more trustworthy to credit card companies for an unsecured credit card. This may also be a good way to go if you're trying to teach yourself discipline or family members, i.e. kids, discipline with making on-time payments. All right, moving into the next slide. You've learned the difference between unsecured and credit card, and hopefully I made it clear enough what the distinction is between the two of them. Next, we're going to talk about types of credit. A lot of people aren't aware that it breaks further down into this. And you might be asking yourself, how much more is there? And the answer is there is layers. There's layers to this. As you are more informed, you'll be able to make better decisions when it comes to your finances with this information. So back to types of credit. We have 3 types of credit here. There's revolving, installment, and open credit. If you want, feel free to take a screenshot of this so you can kind of go back and reassess your own finances and see how many of which you have. But for the first one, revolving, this allows you to borrow money over and over again, much like a credit card every time you swipe it. Installment credit is you borrowing a fixed amount at one point and then paying that back over an agreed fixed period of time and paying a set interest rate. Examples of that, a best example of that is a car loan. You apply for a car loan, they let you know how much you get, you finance the car, you have a set amount that you get told that you have to pay back, and that's spread out, usually monthly, over the term of that loan. So your payment is fixed, your interest rate is fixed, and you know you're going to have the same payment every month until that line of credit, installment credit, is paid off. And then the last one is open credit. Now, I had to do a little bit more digging because I don't really come across open credit too often. But I got a good definition for you. And it's similar to revolving credit, but the difference is that it has an end date on how much money you can borrow. So this option is typically used for HELOCs and renovations when calculating the total can be rather difficult. So you go to your bank, you get an open credit to renovate, I don't know, say your patio. You know it's going to cost roughly about $30,000, but as we know with renovations, things come up, right? So they let you borrow that money, you pay back the money with interest, but you do have the buffer to be able to pull additional credit from that loan in the event that you need it. Hopefully I was able to break that down for you guys a little better. Moving on to the next slide, we're going to talk about credit scores. I know with the students that I work with, the student population I work with, a lot of them don't really understand the difference between credit and credit scores and credit reports. So we're going to get into that today. It's definition time again. So credit scores is basically the prediction of your credit behavior and how likely you are to pay back a loan on time, in a nutshell. So right here, we're going to stop and take a break. I have a quick video I'd like to show you guys, and then we'll get back into it. Go ahead, Jackie.
I'm scared of my credit score. I don't even know what it is. I'm too scared to look at it, because if you look at it, it goes down. But what's this number that we've all been assigned that we're too scared to look at? Someone says, oh, we have to do a credit check. You go, oh, no, don't look at it. Don't look at it. I don't look at it. You shouldn't look at it. If you look at it, it goes down. Don't look at it.
All right. So that's probably, you know, a mixed feeling of how a lot of people feel regarding their credit cards. It was just a quick snippet. So we went over the definition, which is the prediction of your credit behavior and how likely you are to pay back that loan on time based on the information from your credit report. Now, this is typically comprised of a number between 300 and 850. Now, in my professional experience, fortunately, I've never seen anything as low as a 300. Usually they just at that point don't have any credit history, and it will be a 0. And typically I usually see things starting around like the low 400s. Um, Now, contrary to popular belief, there isn't a one credit, like universal credit score. It can vary depending on which credit reporting agency you're using. Why is that? Because different agencies use slightly different means of calculating that number. Now, those 3 lenders are in the US are Equifax, Experian, and TransUnion. Again, I get why do they have to make this stuff so complicated, right? Well, just think of it this way. If we all walked around with great credit scores, there wouldn't be enough money to lend us all, right? At least this is my own personal take on it. Before moving on to the next slide, I want you to think about the 5 different factors that your credit score is comprised of, and then compare it with what you thought you knew with how much I'm getting ready to tell you. Feel free to pause and then come back to the video. All right. So going into the next slide, we're going to dive into how your credit score is comprised. Actually, before we get into that, let's break down what the credit bureau does, doesn't do, and then what they can do first. So what they do is they gather information regarding your social security number, your name, date of birth, current and previous addresses, phone numbers, employment history, all that good stuff, right? And then they monitor your collections and charge-offs, your credit utilization, hint, hint, public records, and your credit accounts. What they don't do, credit bureaus actually don't decide if you're approved. They just give the information to the powers that be for them to make their decision. And they don't create your FICO score, like a lot of people seem to think. They also don't communicate with each other, which one would think, why not? But it's just not something that they do. And this is why the information can vary from company to company. Now, what they can do is they can make money off your data by selling the info to lenders, i.e. banks and creditors, and that's how they get your information to know if you're even worthy of extending credit too. And then they also dispute any and all inquiries that are made to them, typically within 30 days. All right, now we can talk about the factors that make up your credit score. So looking at the pie chart, you can see that payment history is the biggest of them all at 35%. And this is basically how well you do with paying your bills on time. This is why this one has the biggest impact. One thing you don't want to do is make late payments. Even if, you're struggling, I highly recommend you call into your creditor, let them know what's going on because they won't know otherwise, and come up with an arrangement to make sure that you don't show any late payments in the event that you can't make your full monthly payment at that time. All right. After that is credit utilization in at 30%. And this is how much of the limit you've reported at the end of your billing cycle when everything gets reported to the credit bureaus. You always want to try and remain under 30% of your available balance at any given time, but especially once your balance is reported. But even better would be paying off the balance in full so you don't have to worry about anything being reported. Next is going to be your average credit age. Now this comes in at 15%, and this is how long you've had your accounts open for. Recent research has showed that this is heavily impacted by those who do those buy now, pay later loans. Fun fact, which I think I have at the end of the slideshow, is I was doing a seminar, I guess you could say, for students, and I was doing it on buy now, pay later loans. And one thing I learned is those Klarna, Affirm, and Afterpay, there's a few others out there. There are actually several out there. One thing they do is they extend the credit to you, but when you go and you make a monthly or you make an installment agreement with them, right? Say you got $100 purchase and you do it on Afterpay and you're paying $25 a week until you pay off your balance. That actually takes a hit to your credit age because you don't have it for a long period of time. And especially if you're doing that repeatedly over and over again, it does bring down the added average credit age of your account. So just something to know and be mindful of. 15% isn't a lot, but it does add up if you're teetering that line between, a halfway decent credit score and a great credit score. And then we have account mix at 10%. This is just what type of accounts you have. So we had talked earlier about installment accounts, revolving accounts. This is where that stuff comes into play. Creditors like to see a mix of different types of credit on your credit report, and that you're able to ascertain those different types of credit. And then lastly is credit inquiries, and at 10%. And this is how often you apply for credit cards or loans. And while some think that this doesn't matter, it does. Doing this too often can make you look like a huge risk to creditors, in that they start thinking to themselves, well, why is this person constantly seeking, new lines of credit? So be careful when you're going to make those payments at the register, at the retail stores, or even online when they ask you, like, would you like to sign up for a credit card? Think long and hard about it before you do, because it does impact your overall credit score. All right. So as we mentioned or talked about earlier, credit score does range from a 300 to an 850. Typically 750 to 850 is excellent. 700 of 749 is very good. 650 to 699 is fair. And then honestly, anything less than the 600, you got some work to do. Just note that the higher the credit score, the more easily you qualify for loans, and usually the better interest rate you get offered. All right, next we are going to talk about how to read and acquire your credit report to then figure out what your credit score is being based off of. See how this all is starting to kind of play together? So on your credit report is a list of your past and present credit accounts and loans. This includes credit cards, loans, how much money you owe. And then the other big factor when we were talking about that payment history at 35%, they break down and show all your on-time payments and all your late payments. This is why it's important. You want to check your credit report regularly to ensure that the information is accurate and complete. And then anything that you do find that is inaccurate, make sure you take the time to dispute it. Most credit reports, or if not all of them, actually have an address that you can send a letter to if you wanted to dispute any incorrect information on your credit. I know people who sometimes I've seen this happen where if you have a junior in your family, sometimes things get mixed up and you could have something reported that's from a parent rather than yourself. And a simple letter to let them know with whatever documentation is required to prove that it's not you, and they usually remove it off fairly quickly. All right, how to get your credit score. So annualcreditreport.com is the only free government mandated site for the credit reporting agencies. So you can always go there and get your credit report once a year at no charge. But note that it's just your credit score. It's not your credit, or excuse me, it's just your credit report, not your credit score. All right. But the MassMutual Federal Credit Union app and online banking does provide you access to your credit score, factors that impact it, and what you can do to strengthen it. So you might be wondering, how does your credit score affect your finances? So we touched on it a little bit, but a good or excellent credit score can literally save you thousands of dollars when you have a good credit score to back you up and allow for you to get better rates on all loan products. Poor credit ratings are considered higher risk borrowers. I mean, for obvious reasons, right? Meaning that because the risk is higher, they want to make sure that they recoup their costs. So your interest rates are going to be higher. A poor credit score can affect your ability to find housing, rent a car, and even things like life insurance. Okay, so here's an example of what it looks like when you have good credit versus poor credit. So we have a car loan example of $25,000 over a 5-year term. A good credit score would get you somewhere near 4.99% APR. That gives you a payment of $471.72 a month. Total interest at the end, $3,302.74. A poor credit score at 18% has your payment all the way up at $35.04 and a total whopping interest of $13,102.09. You're paying $163 and change monthly more than someone with good credit. And overall, this is astounding. Your interest is increased by $9,799.35. Now, I don't know about you, but those kind of numbers are glaring to me on why it's so important to have and maintain a good credit score. And now we have another example to provide you with a credit card. So you're carrying a balance, let's say, of $8,000, and your payments are about $250 a month, and you don't make any additional charges on this particular card. If you have good credit, your interest rate is 13%, which I know the Mass Mutual credit card that they offer is one of the only cards I've come across lately with interest rates this good. It would take you on average, let's say 44 months to pay that off at the $250 monthly payment. Total interest at the end is about $3,000. If you had poor credit and you're at 18% APR, which this is, being generous or nice because a lot of credit card companies lately are minimum 20% all the way up to 24 and 29%, which just sounds crazy when you think about it. But say it's 18% APR, you have 235 payments to pay it off. Your total interest is looking at about $50,750 to pay off that $8,000 balance. Let that sink in for a minute. If that's not cause for concern to want to take action after this webinar, I don't know what to tell you. I don't know what would, shake you up enough. All right. So next, we are going to talk about how to improve your credit score. All right. So remember when I told you that we would get to the slide that further discussed your credit score and how it would impact your pockets? That's a mouthful. Let's take a look. So first, you want to review your credit reports, as we mentioned. It helps to know what you might be working on or what might be working in your favor or against you and dispute any errors you come across. The next thing you want to do is make sure that you do pay your bills on time. As the payment history has the biggest impact on your score, pay your debts responsibly and on time. Trust me, it will work in your favor. And for those who have, consistent checks, and by that I mean the checks that you get every pay period are roughly the same amount. Feel free to take a look at those bills that stay the same from month to month and automate those bills to reduce the chance of you missing that payment. Another thing we can do is set reminders in our phones to make that payment and to make sure you allow for, a day or two for the payment to post. I know some places get a little tricky where if you make your payment on a Friday and it's not in before 1 o'clock in the afternoon, now that payment doesn't get applied until Monday. And if your due date was over the weekend, you could take a hit. And then for my old school folks who like to deal with paper, I'm one of those too. Just create a filing system for yourself, right? Next, we want to keep old accounts open. The older your credit age, the better. So don't be so quick to cancel or close those accounts just because you're not using the card anymore. Make sure you do your research to figure out how long you've had that card open, if you have any other cards with that same length of credit history, because if you don't, that could end up dipping your credit score significantly if you choose to close that account. All right. And then, as I mentioned earlier, buy now, pay later loans do affect this factor. Next is the 30% utilization. Never carry a balance greater than 30% of the credit limit. And this isn't your credit as a whole, it's for each card that you carry. So if you have a $10,000 limit on a credit card, try and keep that balance under $3,000, especially at the time that you near the end of your billing cycle, where they get ready to report that balance to the credit bureaus. Keep it under 30%. And then limit the new inquiries. Soft inquiries don't hurt you, but hard inquiries do. When it comes to things like, shopping around for mortgage or car loans, they do give you a grace period to do all those hard inquiries in, where it gets counted as just one look rather than several. So make sure you check with your bank when the time comes to do those things and see what that grace period is for that particular bank. And then if you don't have a credit score, you don't know what it is, know that the credit union at MassMutual can absolutely help you with that. They do have the ability to sit with you one-on-one and create a plan to help start building your credit responsibly. Lastly, I added some FAQs and myths that we can go over that I typically get asked a lot. One is, or the first being, how long does it take for negative information to age off of your credit report? And the answer to that is generally 7 years. And I know it seems like a really long time, but it's it's the truth of the matter, right? You can do a lot of damage in a short period of time, but it takes a long time for that damage to wear off. So this is why it's so important to make sure your payments are on time, because it does take quite a while for that stuff to age off of your credit report. Does paying off a loan help or hurt your credit? If the loan you pay off is the oldest on your credit line, as mentioned, the age of your credit will be considered newer and your score will drop. It eventually does go back up over time as long as you're consistent. If the loan that you pay off, though, is your only loan, then your credit mix that we talked about that was worth 10%, that's going to kind of suffer as well. Third question I get is, will paying the minimum on my cards improve my credit score? And the answer, simply put, is no. You need to pay at least the minimum on your credit card every month to have on-time payment history. Paying off your balances in full every month will positively impact your score as it improves the credit utilization percentage. And then another one, how long does improving your credit score take? And the answer for this, a lot of people don't like, but it just depends on why your credit score is low. If the major negatives are credit utilization, and then you pay off your loan balances, your score can improve drastically in as little as a month. If your credit is low because of multiple collections, poor payment history, that can take a lot longer to roll off and be replaced with on-time payments to see positive increase. All righty, so we have come to the end of the last part of our financial literacy series. I want to thank you guys again for tuning in with me. As always, I look forward to these. If you guys have any questions, feel free to email the email address here, and the MassMutual Credit Union team will be glad to answer those questions for you. There's also a phone number and website for you guys to take a look at. Thanks again, and I hope you guys have a great day. Thanks.
As always, Andrea, it's a pleasure. We appreciate you hosting our financial series. Thank you so much.
Absolutely, it's my joy. No problem.